Rohitash, in your conference call, you all say that margins may remain volatile due to wage hikes in Q2 and Q3. So, what are you saying? I mean, and then you go on to say that returns to office costs are also likely to fall. Are you expecting margins to be lower, higher? What is the guidance for the remaining quarters?
Hi, good morning, and thank you for having me. So you heard it right that our revenues were about $45 million, which is about 6% down sequentially and about 11% down in dollar terms on YOY basis. Margins in Q1 specifically were relatively better due to excellent cost management, both on the people cost as well as G&A cost side. We could also move in this quarter almost everybody to work from home, enabling them. And from Q2 onwards, we have committed wage hikes to our staff in a staggered manner, some in Q2, most in Q2 and some in Q3. And also we expect that because clients are expecting us back to be working from office in some small percentages, we will have to run our offices in almost full swing. And that is what I mean by return to office cost, because we will have to maintain dual infrastructure of work, majority of people working from home while offices are still running in almost full swing in the G&A sense. And also depreciation is likely to increase because we bought a lot of computing assets for our working from home agents in the end of Q1. So all put together, we think the margins upside from here on will remain volatile around the Q1 mark in absolute sense. But revenues in dollar terms is a little more visibility that it will likely increase from here on.
Okay. Rohitash, good morning. That's on the margins. Now, I really do want to focus on the business and the revenue itself, because out of 1, 2, 3, 4, 5, 6 quarters that our colleague Rima has given us data on, forget Q1 of this year. I mean, the last couple of quarters, 4 have been, negative quarters for you in terms of growth. So for FY21 as a whole, can you hope to come back to reasonable growth? Are deals coming in? How's pricing looking with your clients?
So there are a couple of good things on the pricing front, at least. So H2 of last year was fairly strong for us in terms of pricing upticks from our key clients. And these are typically contractually committed hikes, and we were able to get many of them during H2. So that is on the pricing momentum going into FY21 and onwards. We are not at this point seeing any conversations about discount due to the current economic situation. So that's the second trend. In terms of, growth trajectory, you are absolutely right that not only 6 quarters, but actually almost 3.5 years or so, revenue has been flattish around $50 million mark per quarter. And we have seen this is because of 2 reasons. One is because 3 or 4 of our large clients have undergone some strategic change in terms of their footprint, sharing more work with their own in-house centers as opposed to vendors, number one. And number 2, we ourselves are going through a shift where we are pushing more managed services, where we control the input and commit to client the output. And these services are typically driven by IP or technology that we own in those respective areas.
So short point, no, Rohitash, what is the answer therefore? Are revenues round the corner going to rise? Is there any U coming up in terms of revenues?
Our visibility for long-term future is very less based on the pipeline. Pipelines mature within 3 to 6 months for us. So our commentary can be only for, next 1 to 2 quarters, which is what I said. There will be an upswing from Q1 levels. Beyond that, it's hard to comment on a V or U shaped.
Okay, so for the next quarter, your guidance is higher.
Correct, from Q1, yeah.
All right.